Pre-2001,
Yeah.
South Africa worked on a source-based system of taxation.
Which means what?
What that means is South African residents or South Africans were taxed on income derived in South Africa or deemed to have been derived in South Africa.
Right.
So based on the source, right?
Right.
They thereafter moved across to a residency-based system. So now, regardless of where your income is sourced or derived from, if you're a South African resident, by virtue of that residency rather than prior by virtue of the source, you were taxed on your worldwide income. Now, if we were to let's look at Namibia, our neighbor, but very similar tax regime. You know, Namibia, their tax legislation is very close to ours, although a lot shorter and much easier to read. I think I got through their legislation in about 2 or 3 hours, so it was a good time. But ultimately, a country like Namibia works on a source-based system, whereas South Africa works on a residency-based system. Now, what that means is Namibian-sourced income is taxed at source, whether you're a South African resident or not. It's taxed in Namibia, right? So you've got a withholding tax in Namibia, okay? So source-based income. You then receive it in South Africa. South Africa says, hey, you know what? Actually, this is your worldwide income. You get taxed again.
Yeah.
And that is where the Double Taxation Agreement comes into play, because the Double Taxation Agreement between two contracting states, as with South Africa and Namibia, effectively reduces some of those withholding taxes. So as an example, if it was a withholding tax on dividends that should have been at 20%, your Double Taxation Agreement can regulate that to a 10% or a 5%.